China just pulled the trigger. They instructed their banks to dump American debt. Not tomorrow, not eventually, right now. And the number is staggering. We are talking about $682 billion in treasury holdings that have been quietly unwound. This is not speculation anymore. This is policy. Bloomberg broke the story this week. Chinese regulators told financial institutions to limit their purchases of US Treasuries and reduce existing positions. The official excuse is market volatility and concentration risk, but that is corporate speak for something far more dangerous. This is Beijing systematically walking away from the American financial system. For decades, we had a deal. China sent us cheap goods, we paid them in dollars. They recycled those dollars back into our debt market. That cycle kept interest rates artificially low. It subsidized your mortgage. It kept your car loan affordable. It made the American dream possible for millions of families. That deal is dead. The divorce papers have been filed. And you are the one paying alimony. The numbers that nobody wants you to see. Let me show you exactly what China has been doing. In November 2024, China held $767 billion in US Treasuries. That number climbed to over $900 billion by August 2025. Then the selling started. By November 2025, they were down to $888 billion. And the latest data shows they dropped to $682 billion in November. That is a $200 billion reduction in just 3 months. This is the lowest level since September 2008. Think about that date. September 2008. That was when Lehman Brothers collapsed. That was when the global financial system nearly imploded. China has not held this little American debt since the depths of the financial crisis. But here is what makes this truly alarming. China is not alone. This is a coordinated retreat across the BRIC nations. Brazil held $229 billion in American treasuries in November 2024. 12 months later, that number dropped to $168 billion. India went from $234 billion to $186 billion in the same period. These are not random fluctuations. This is a pattern. This is policy. And while they sell our bonds, they are buying something else. Gold. China has been purchasing gold for 14 consecutive months. Their official reserves now stand at 74.15 million ounces, valued at $310 billion. Every single month, they add more. In December alone, they purchased another 30,000 ounces. This is not portfolio diversification. This is financial warfare. They are trading paper promises from a hostile government for hard assets that cannot be frozen or sanctioned. They saw what America did to Russia in 2022. Overnight, we froze hundreds of billions in Russian assets. China is making sure that weapon cannot be used against them. Why this destroys your buying power? Most people do not understand how the bond market works. So let me explain it in plain English. When China sells US Treasuries, they are dumping bonds onto the market. When supply increases and demand stays the same, prices fall. This is basic economics. But here is the critical part. In the bond market, price and yield move in opposite directions. When bond prices drop, interest rates spike immediately. Your mortgage rate is tied directly to the 10-year Treasury yield. Historically, the spread between the two has been between 1 and 2 percentage points. Right now, the 10-year Treasury is trading around 4.26%. The average 30-year mortgage rate is sitting at 6.09%. That is a spread of 1.83%. But what happens when China dumps another $100 billion in bonds? That yield climbs. If the 10-year Treasury hits 6%, your mortgage rate mathematically has to hit 8% or higher. This is not a prediction. This is arithmetic. And at 8% mortgage rates, the housing market collapses. Nobody can afford to buy. Nobody can afford to refinance. The wealth effect that has kept consumer spending alive for the past decade evaporates overnight. The Federal Reserve cannot save you from this. The Fed controls short-term rates. They set the federal funds rate, but they do not control long-term rates. The market controls those. The Fed could cut their benchmark rate to 0 tomorrow. But if China dumps $50 billion in bonds that same afternoon, your mortgage rate goes up, not down. This neutralizes the most powerful tool the Federal Reserve has. Think about what this means for your daily life. Every loan you take out gets more expensive. Your credit card interest rate climbs. Your car payment increases. That business loan you were considering becomes unaffordable. The entire economy slows down because the cost of money just went through the roof. The demand crisis. Nobody is talking about. For decades, America has been running massive budget deficits. We spend more than we collect in taxes. A lot more. Right now, the federal deficit for fiscal year 2026 is already $602 billion. And we are only 3 months into the fiscal year. The Congressional Budget Office projects the full-year deficit will hit $1.9 trillion. To fund this deficit, the Treasury has to sell bonds. Billions of dollars in new bonds every single week. Somebody has to buy them. For years, that somebody was China. They were the guaranteed buyer at the auction. Now, they are not just absent. They are actively selling the bonds they already own. This creates a supply shock. Imagine a neighborhood where every house goes up for sale on the same day, but there are 0 buyers. What happens to prices? They collapse. The bond market works exactly the same way. When you have more sellers than buyers, something has to give. And what gives is the price, which means yields spike, which means interest rates explode. The Federal Reserve is doing quantitative tightening. That means they are selling bonds, not buying them. American banks are full. They already hold too much government debt and are sitting on massive unrealized losses. Japan is struggling to save its own currency. They are selling treasuries too. That leaves you, the American investor. You are the only buyer left. And to convince you to buy a 10-year bond, the government has to offer you a much higher interest rate. This creates what economists call a crowding out effect. Higher treasury yields force every other interest rate in the economy higher. Corporate bonds become more expensive, municipal bonds become more expensive. Everything becomes more expensive because the so-called risk-free rate just went up. The interest payment? Death spiral. Let me show you how bad this gets. The United States now has $38.5 trillion in national debt. That is not a typo. $38.5 trillion. And we pay interest on that debt. In the final 3 months of 2025, the government spent $276 billion just on interest payments. That is $31 billion more than the year before, a 13% increase. For the full fiscal year 2025, we spent $1.22 trillion on interest alone. Think about that number, $1.22 trillion. Not on schools, not on roads, not on defense, just interest. That is more than we spend on the entire military budget. And it is growing exponentially. Why is it growing? Because interest rates are higher. When China sells bonds, yields rise. Higher yields mean we pay more interest on new debt. But it also means we pay more when we refinance old debt. Every time a treasury bond matures, we have to issue a new one to pay it off. And that new bond carries a higher interest rate than the old one. This is the debt spiral. Higher interest rates mean bigger deficits. Bigger deficits mean more borrowing. More borrowing means more supply. More supply means lower prices. Lower prices mean higher yields. Higher yields mean even bigger interest payments. It feeds on itself, and there is no exit ramp. The Congressional Budget Office projects that interest costs will consume more and more of the federal budget every single year. Soon, interest payments plus Social Security and Medicare will eat up every dollar of tax revenue. That means no money for anything else. No infrastructure, no education, no defense, just debt service. Why China is doing this right now? The timing of this move is not random. China did not wake up one day and decide to dump American bonds on a whim. This is strategic. This is calculated. And the timing lines up perfectly with the trade war. President Trump has imposed 60% tariffs on Chinese goods. That is not a negotiating position. That is economic warfare. When you slap 60% tariffs on imports from a country, you are telling them their money is not welcome here. You are weaponizing trade policy. China looked at that situation and made a rational calculation. If America is going to wage economic war, why would they continue financing American debt? Why would they lend money to a government that is actively trying to destroy their economy? The answer is they would not. So they stopped. But it goes deeper than tariffs. This is about the weaponization of the dollar. In 2022, when Russia invaded Ukraine, the United States froze Russian assets overnight. Hundreds of billions of dollars in reserves just vanished. Russia could not access their money. It was held hostage by Western financial institutions. China watched that happen. They learned a very important lesson. Dollar assets can be weaponized. Treasury bonds can be frozen. If you hold your wealth in instruments controlled by a hostile government, you are vulnerable. So they started moving their wealth out of the dollar and into assets that cannot be sanctioned. Gold, commodities, real estate in neutral countries. Treasury Secretary Scott Bessent can downplay this all he wants. He can say China is not weaponizing their treasury holdings. But actions speak louder than words, and the action is clear. China is reducing their exposure to American financial assets as fast as they can without crashing the market. The petrodollar is dying. For 50 years, the world ran on a simple system. If you wanted to buy oil, you had to use US dollars. This created permanent demand for our currency. Every country on Earth had to hold dollars in reserve just to buy energy. It was the greatest financial advantage any nation has ever had. That system is ending. China is the world's largest oil customer. And they are now paying for oil in yuan. They have set up currency swap lines with Saudi Arabia. They are cutting side deals to bypass the dollar entirely. For the first time in half a century, you do not need dollars to buy oil. This reduces global demand for dollars right when we need it most. When fewer countries need to hold dollars, they have less reason to buy treasury bonds. The magic credit card that allowed America to run up massive debt without consequences is being declined. Saudi Arabia is cheating on us. For 50 years, they were married to the dollar. Now they are accepting other currencies. This is a direct attack on what economists call our exorbitant privilege. We have been able to print money and export inflation because the world needed our currency. When that need disappears, the privilege disappears. China is attacking from both sides. They are dumping bonds on the supply side, and they are reducing dollar demand on the currency side by bypassing the petrodollar. This is a pincer movement. They are squeezing the dollar to death from multiple angles. The hidden gold accumulation. The official numbers say China holds 74.15 million ounces of gold, but many analysts believe the real number is far higher. Independent estimates suggest China may hold double what they officially report. Think about why they would hide this. If the market knew China was buying massive quantities of gold, the price would spike even faster. By underreporting their purchases, they can accumulate more at lower prices. This is a multi-decade strategy. They are building a war chest. Gold is not just an investment for China. It is insurance. It is the only asset that works in a blackout. It requires no electricity. It requires no internet. It works in a war. And most importantly, it cannot be frozen by sanctions. While China buys gold, they sell treasuries. This is asset reallocation on a historic scale. They are trading paper from a hostile government for physical metal that holds value in any crisis. This is what smart money does before a currency collapse. Central banks around the world are following China's lead. Global gold reserves now account for 28% of total international reserves. In the 1990s, that number was 21%. Central banks are quietly moving away from dollars and into hard assets. This is de-dollarization in slow motion. What this means for your mortgage. Let me connect the dots directly to your life. When bond yields rise, mortgage rates follow. The 30-year fixed mortgage tracks the 10-year Treasury yield with a spread that has historically been 1.5 to 2 percentage points. Right now, mortgage rates are around 6.1%. If China's selling pushes the 10-year Treasury to 6%, mortgage rates will hit 8% or higher. At that rate, the housing market freezes. Nobody can afford to buy. Nobody wants to sell because they are locked into a lower rate. The Trump administration knows this. They are desperately trying to talk mortgage rates down. Treasury Secretary Bessent has been on television blaming Japan for bond market volatility. He has been coordinating with foreign officials to calm markets. But jawboning only works for so long. The fundamentals are what they are. Too much supply, not enough demand. Yields have to rise. And when yields rise, your buying power collapses. A $500,000 mortgage at 6% costs about $3,000 per month. That same mortgage at 8% costs about $3,670 per month. That is an extra $670 every single month. Over 30 years, that is an extra $241,000 in interest payments. Most families cannot absorb that kind of increase, so they just stop buying. They rent instead, or they move in with parents. The American dream of homeownership becomes unaffordable for an entire generation, and all of this is driven by China's decision to dump US debt. The banking crisis nobody sees coming. American banks are sitting on a time bomb. According to the FDIC, banks currently have over $600 billion in unrealized losses. These are losses on bonds they bought when rates were low. When interest rates went up, the value of those old bonds collapsed. As long as banks do not sell these bonds, they do not have to recognize the loss. They can pretend everything is fine. But there is a catch. If depositors get scared and pull their money out, banks are forced to sell bonds to raise cash. When they sell, they lock in the loss. And if the loss is big enough, the bank goes under. This is exactly what happened to Silicon Valley Bank in 2023. Depositors panicked. The bank had to sell bonds at a loss. The losses were bigger than the bank's capital. Game over. And that was with interest rates far lower than they are today. Now China is pushing rates even higher. Every time they dump bonds, yields spike. Every time yields spike, the hole in bank balance sheets gets bigger. China knows this. They know the American banking system is fragile. They know that higher rates stress the entire system. This is financial pressure applied with surgical precision. The Federal Reserve's emergency lending program has expired. The Bank Term Funding Program that saved banks in 2023 is gone. If another regional bank fails, the Fed has two choices: let it collapse and risk contagion, or print trillions to bail it out and destroy the dollar. Either way, depositors lose. The inflation tax is coming. Here is the end game. The government cannot afford to let interest rates stay high. The debt service costs are already unsustainable. If rates keep climbing, interest payments will consume the entire federal budget. That leaves no money for anything else. So what will they do? They will force the Federal Reserve to step in. The Fed will restart quantitative easing. They will buy Treasury bonds to push yields down. They will print trillions of new dollars to absorb the supply that China is dumping. This is money printing, call it whatever you want. Market stabilization, yield curve control, liquidity operations. It does not matter. The result is the same. More dollars chasing the same amount of goods. That is inflation by definition, and inflation is a tax. It is a tax you never voted for, but you pay it every single day. You pay it at the grocery store when milk costs $6 a gallon. You pay it at the gas pump when fuel hits $5. You pay it when your rent doubles. The government is stealing your purchasing power to bail out their debt addiction. This is the stealth wealth transfer. Your savings lose value. Your paycheck buys less. But the government's debt gets inflated away. They borrowed dollars when they were worth something. They pay them back with dollars that are worth far less. You are the one subsidizing this scheme. Where smart money is hiding. So what do? You cannot stop China from selling bonds. You cannot fix the federal deficit, but you can protect yourself. And the first rule is simple. If you cannot touch it, you do not own it. Paper assets can be frozen, accounts can be seized, digital entries in a database can disappear with a keystroke. Hard assets cannot. Gold in your hand cannot be confiscated remotely. Land cannot be deleted. Physical property has value that persists even when the financial system breaks. This is why billionaires are buying farmland. This is why family offices are accumulating gold. This is why smart money is moving down the risk pyramid. They want assets closer to the base of reality. Things people need to survive: food, energy, shelter, precious metals. The traditional 60-40 portfolio is dead. For decades, advisors told you to put 60% in stocks and 40% in bonds. That worked when bonds were safe. But bonds are not safe anymore. They are the source of the risk. When yields spike, both stocks and bonds can fall together. You need liquidity, but liquidity does not mean cash. Cash is trash in an inflation environment. Liquidity means owning assets that anyone anywhere will accept. Gold fits that description. It is money in every country. It requires no translation. It has been valued for 5,000 years and will be valued for another 5,000. China understands this. That is why they are building a wall of gold around their economy. They are preparing for a world where dollars are no longer dominant, where trade is settled in hard assets instead of paper promises. You should be preparing for that same world. The BRICS alternative system. China is not just selling US debt. They are building a replacement system. The BRICS nations are creating their own financial infrastructure. In November 2025, the chairman of the Central Bank of the United Arab Emirates completed a landmark digital currency transaction with the governor of the People's Bank of China. This inaugurated Project M-Bridge, allowing countries to bypass the US dollar entirely for bilateral trade. China is positioning gold as the settlement mechanism for this new system. The dollar's share of global reserves is falling to 57%, the lowest since the 1990s. Meanwhile, central bank gold holdings have doubled since 2014. The window is closing. Right now, you can still convert dollars into hard assets. No penalties, no restrictions. But this window will not stay open forever. When the crisis accelerates, capital controls will be imposed. Central bank digital currencies are coming. Every transaction will be tracked. They will be able to stop you from buying gold with the flip of a switch. This is why China is moving now. While they still can, while dollars can still be converted into real assets. Once the trap closes, it will be too late. The question is not whether China will keep selling. That decision has already been made. The question is whether you will prepare. Your mortgage rate is tied to bond yields. Bond yields are rising because China is selling. Rising rates slow the economy. Slower economy means lower tax revenue. Lower revenue means bigger deficits. Bigger deficits mean more borrowing. The cycle feeds on itself. There is no painless exit from this trap. Either we print money and create inflation, or we let rates rise and create a depression. China has forced America to choose between two disasters. The smart money is already moving. Central banks are buying gold at the fastest pace in 50 years. Billionaires are diversifying into hard assets. Countries are building alternative payment systems. China sold $200 billion in treasury bonds in 3 months. They are buying gold every single month. They are instructing their banks to reduce American exposure. These are facts. The bond market is screaming. Yields are rising. The cost of government debt is exploding. America cannot spend forever without consequences. We cannot print money forever without inflation. We cannot rely on foreign creditors when those creditors become adversaries. China just sold your debt, and nobody wants to explain why. Because the truth is, we are living on borrowed money and borrowed time, and the lender just walked away from the table.